money in stocks is not to get scared out of them. On that thought, welcome to our Zoom web series hosted by One Tree Hill and PMS Cart on the Juggernauts, conversations with uncommon and curious fund managers. Hi everyone, my name is Jai and I have with me today Hemant Patel, founder and CIO at Alder Capital. Welcome Hemant to our show.
Hi Jay, happy to be on the show today.
Excellent. Hemant, what we like to sort of start off with is what we call our machine gun 15. It's a quick fire round of questions. Will hopefully make you think and have as much fun as we do on this in this part, right?
All
so
right.
If you're ready, we can start off.
Sure, go ahead.
Perfect. Okay. Will oil go back to zero in any future contract?
I don't think so.
Okay. How would you rate the research on the street from 1 to 10, 1 being the lowest, 10 being the highest?
They have a difficult job. I'll rate them as around 4 at the moment.
Okay, fair enough. Would you suggest diversification or concentration in equity?
Concentration.
Okay. How long do you think India will remain an emerging market?
I think it's already emerged. So.
Okay, interesting. One of the biggest red flags that you see outside of corporate governance when you pick stocks?
More to do with management's zeal, entrepreneurs' zeal to allocate capital, which probably is not the right thing of lately.
Okay, fair enough. The question on everybody's mind and the most difficult, are we at the bottom?
I don't think so.
Okay. Which balance sheet do you think is the most stretched? The government, the corporate, or the individual?
I think it's the government.
Okay. That's not a good place to be.
It's not a good place to be. It's a difficult place to be, and to get out of it is going to be another whole.
Okay, but at least with everyone talking about debt as part, don't you think the corporates will also find it difficult?
Absolutely. I think they are going to find it difficult to raise capital. Not everyone will be able to raise capital, and at the time when they want it the most. So until unless the government does what they're talking about in terms of guaranteeing corporate debt, whether it's MSME they're talking about, probably that should help.
Got it. Would you do top down or bottom up?
Bottom up.
Okay, interesting. So of all the people that we've talked to on this, it's an even split. I'm just putting it out there. So, okay.
Love to get the survey out after you're done with this.
Oh, it will be out definitely. And just taking a break from this, but the amount of the diverse information that sort of this crisis brings and the different views is just fantastic. But anyways, let's get back to Machine Gun 15. One aspect that very few people know about you.
I'm a good cook. I'm a good cook.
Okay. All husbands are in this thing.
No, that's what I said. I'm a good cook. I put the adjective over there.
Okay. Okay, fair enough. Would you double down or double up?
Double down.
Double down. Okay. Okay, fair enough. Obviously, and we just alluded to this with the debt funds and what is happening with a few AMCs in terms of closing their funds. Do you think this will snowball into something good, bad, or ugly for our markets?
In the short run, yes. Maybe it's going to be a stress because the reserves which corporates actually kept for an incremental yield of 2 to 3%. Just overnight resulted in illiquidity for them, which is when they needed it the most. So at the moment, I think the flows are going to go out. But if you ask me, I still believe in the financialization theme on India.
Okay.
There's a lot of savings tsunami which is still coming in.
Right.
A nice way to think about it is what was put out this recently, that there's around 8,000 crores SIP, which continues to come per month, right?
Sure.
And completely offsetting the FI inflow and the outflow, the outflow which happened. So in a way, I think we are in a better footing from where we are for the next 10 years in terms of where the capital flow is coming to the market. So I'm not too worried about it. Short term, yes, the government is actually stepping in to manage it to a certain extent. However, unfortunately, we are at a point where we really can't solve the credit crisis with ample amount of liquidity measure, right? So,
Sure,
I mean,
of course.
it's something that we have to actually live up to, and hope we find a solution to it.
Correct. So we haven't seen any measure. Obviously people have said that we'll put in 50,000 crores liquidity for mutual funds, etc. But that still doesn't address the root issues.
Absolutely. So mutual funds, banks, in another way, will have to actually buy these assets.
Right.
And they never wanted to buy these assets in the first place, even by taking longer term funding from the RBI. Right. So there's no need for them to do it today when the line has been thrown open to them. I mean, it's very clear that the risk appetite is completely lost. And corporate India's credibility is at risk over here.
Right.
It's better that the government thinks about how to save some of these corporates. It's just not good enough to say that I'm going to shift the IBC process a little bit down the line.
Right.
Some long-term leash has to be given to small, medium, and large enterprises.
Okay, fair enough. We almost at to the end of this. Just a couple of more questions more, and the next one is the most interesting question. Is that where do you think investors across decades have made the same mistake over and over again, or have had this one misconception of the markets?
The biggest place where they've always made a mistake is choosing the wrong managers or the wrong people, right? I think in our core philosophy, we think of 50% weightage given to management, right?
Sure.
Whether it is analysts or whether it is fund managers, a lot of them take very little time to understand the people behind the business, right? Whether you make a wrong investment decision is the after effect of the kind of person you are. This was taught to me in my earlier, erstwhile days when I used to be an investment analyst.
Right.
And I used to go around with someone who Warren Buffett actually had many good things to say about. Okay. And when we used to go and meet companies together, believe it or not, I mean, he never had questions about, can you tell me the margin profile of your products? Yeah. Tell me the growth probability, give me the unorganized market share, how is your competitors doing? None of those, it's very surprising that he would ever ask that. Right. He, in fact, would go and ask those guys, saying, can you tell me about your hobby? Can you tell me about what time do you get into work? How did you manage this earlier crisis? I mean, I believe that it was very difficult. Did you kick people out? How long is that person out there? How long has he been there? So, I mean, it's very odd questions, but it basically gets down to the DNA of how a person thinks. I mean, is he an humble? Is he a focused leader to drive organizations? And I think time and again, people don't pay too much of attention to it. It's only later on you come to realize that these were great managers and they resulted in profitability and growth for their own businesses, and they didn't do anything stupid, right? Or they leveraged the balance sheets outside the listed entity. All those things are the after effects, but very little time is spent on the real important issues.
Fair enough. Great. I think you've done a great job, and your sort of coffee with Karan hamper should be sort of reaching your place as soon as the lockdown ends. But talking of the lockdown, and I believe you guys are in Bombay as well. Where do you see the lockdown going?
So we put out a recent investor note where we said, unfortunately, we are going to have a hard lockdown followed by intermittent lockdowns. Okay. And the problem is not gone. The epicenter of the issue is still around. But people will learn how to work around this issue. Either the hard way or the easier way. The easier way would be they understand it faster because it is spread a lot more, and they take cautionary measures, which is social distancing to all the other things at workplace. Or it could be how we Indians unfortunately have learned things, right? We have learned by way of accident. So until unless we have a major accident, we're not going to learn. So, and that process is going to be a lot more painful. But either which case, I don't believe that we are going to have this go away in the next 1 month or 2 months. It's going to persist for a large part of this year, and it is going to have fallouts on consumption, the economy, sentiments, and a lot of things.
Right.
Unfortunately, it's not a pretty picture that I'm painting at the moment.
No, that's I think it's good to be sort of call a spade at the end of the day. While I don't think anyone is questioning the longer term story that could potentially play out in India, I think obviously there is a lot of confusion regarding the shorter term. Because we have fund managers saying that look, ignore the shorter term. It should not make a difference. We have fund managers saying that look, be very wary of the shorter term because you want to bounce back from the shorter term, right? So maybe preserve some cash and then sort of go on from there. So a lot of various things, but in effect, what I hear is it'll be a sort of a W-shaped, sloping downwards lockdown, right? Where it eases and locks down, when hopefully during that time the curve sort of flattens and starts to come down as well.
Yeah, and one should not even, while we all assume and presume that this is going to happen, I think you must be aware of what recently Mr. Poonawalla from Serum Institute actually had said, right?
Sure.
It's heartening to see corporate India step up and do things out of their own balance sheet. While, yes, there might be a profit motive, but it's just the fact that you're taking the risk head on and doing things well ahead of time. To make sure that you might have a solution to the problem that we have well ahead of the 12 to 18 months that people really talk about. So I think there are a lot of things that will happen. There are 70 companies working on it. There are other companies who are working on drugs which can be used to treat critically ill patients, right? I do believe that there could be a 1 or 2% chance in it. But I'm sure that the chance will be a lot more earlier than what all of us think.
You're not talking about the disinfectant, right?
I'm not talking about that disinfectant. I think Dettol put out an advertisement saying, please don't drink Dettol. It's just incredible.
Yeah, it is. It's fantastic, the world that we live in right now. Not in terms of people, also in terms of people rather, but just what is happening around. With negative yields, negative oil prices, and I think everyone's sort of putting out bets on what is going to go next into or below zero.
Yeah,
but great
times.
Yeah, absolutely. And one of the things that a lot of people want to know about, and something that you also alluded to, when you used to go meet the management, is that to understand the person better, right? So a couple of questions that we have for you. One is, how did the name come about of your PMS or your of Alder Capital? And second is, what was your first interaction with the stock market?
Okay, so interesting question. So the name came about because we wanted something to do with a tree, right? Because it symbolizes longevity, it symbolizes sustainability. It lets the ecosystem thrive around it. And alder in particular is a very unusual tree which thrives in a swamp where it has an entire ecosystem which thrives in a swamp underneath it, right?
Okay.
So we just wanted to actually give it some sort of a meaning, saying, there will be a lot of investors who are trying to figure out, navigate their way through this world, and hopefully Alder can actually give them the direction. So Alder was something that we chose.
Okay.
My first instant with the stock markets was not one of the most pleasant ones. It was way back in some 1997.
Wait, how old are you?
I'm 45.
No, 1927.
45, I'm sorry. So it was one of those times when you just out of college and dad said, okay, we have this little bit of capital. What do you want to do with it? And I said, why don't we go and invest into these hot IPOs? And those good old days, by the way, NBFCs were like a really hot topic.
Sure. Things have changed, right?
Things have changed. It's incredible because at that time, many people know this, but at that time there were like 55,000 NBFCs, right? As per RBI.
Of course.
And then it dropped, I think 2 years later to barely around 10,000. So you can imagine the colossal impact which have happened to IPOs and companies which came up. So we lost everything. But then the funny thing is, after that, he gave me a book which I had to read 3 times to understand what the hell he's talking about, right? One of those unusual things. And he gave me a book by Robert Hackstock. the Warren Buffett way. The first book that I actually read, and I couldn't understand what the hell it was about, meaning investing book.
Sure.
So that was my first initial experience of stock markets.
Okay, fantastic. And I think you guys have definitely come a long way with your PMS, and I think you've been doing well across different time frames. So the obvious question that comes out, what has been your edge, your processes, your USPs, sort of, that has contributed to your success in investing?
If I were to summarize it in a simple word, it's basically focus. We have always thought about it in this manner that it's impossible for us to know everything around, right? But we can do a few things better than others. And we have focused. I mean, I've been a consumer analyst for over 17 years, and my team also have been consumer analysts or have worked in private equity funds where they have actually been consumption specialists.
Sure.
Right? So the entire team is basically of consumption-based team and ideas that we actually generate within. So we narrowed down the universe of 5,000 odd companies into barely around 250, right? And within that, we segregated it to focus a little bit harder onto people in management and businesses that we think probably have more competitive advantage than those which don't, right? And what it enables us to do more than anyone else is it enables us to turn every pebble on the beach. It's as simple as that. And when you start doing more of it, the more conviction you get, and then the more insights leads to also a little bit of longevity in terms of better performance as well. So that's exactly what we've been doing. Focus is the most important thing that we follow, and we are a consumption-centric fund. But just a caveat, when we say consumption-centric, it doesn't mean investing only into levers and Nestle's of the world. We look at consumption as a consumption wallet. A consumer today has got capabilities to invest into branded business, which are asset light, which are maybe staples. It could be discretionary, or it could be anything other than B2C businesses, which could be either savings products or it could be investment products. So there are a lot of facets to this entire consumption story that we look at. It's not only lever and Nestle's of the world.
One of the questions that comes up, and whenever we're talking to investors, is what they're always interested to know is that is he someone who will hold a stock for eternity, or is he coming with that philosophy? Is he coming with a philosophy of, look, while the structure or what we've gotten into, or the philosophy of getting into a stock holds, I'll hold it for how much ever time. And also, so that's part one. And part two is, where have you gone wrong? If you could say a sector or a stock, or what has been sort of your shortest holding period in a particular stock?
Many questions there. Okay, so let me take buy and hold strategy is what we like to say and practice, but there are buckets that how we look at businesses. There is an incredible bucket, as we call it, as where businesses that we want to own for eternity or even beyond 10 years. Even there, we have trim positions where sometimes when we buy things and they run up like 150, 200% in just a year's time. I mean, that's the kind of return that we would have expected these stocks to deliver over 5 years, right? Or a little bit beyond. And they deliver within a year. So when the risk to reward becomes completely skewed in the short run, even at the best of what we own, we try to trim it down. At the same time, there are positions that we buy into which are extremely short-term in nature. Even in the consumption universe, they might not tick all the boxes that we want to buy into, but they tick majority of the boxes, and they provide an opportunity because of an adverse business cycle or because of adverse sentiments, or it could be any other factor. And when we think that there's a possibility that this can reprice and people are missing out on the earnings trajectory, we try to invest into those assets at a very short period of time. But the framework doesn't change. It is still consumption. It is still asset light. It is still some of the simple things that we keep looking at. And that's how we manage it in terms of our timelines. There are businesses that we held for from the time we have started. And there are businesses that we held and sold and we want to get back into it at the appropriate time. But it's a fluid universe. There are only few names which actually stick into our portfolios for a long time and consistently keep doing what they're doing. I'm sorry, Ajay, I think I missed out on the second question you had, which was
the shortest holding period for any stock. Like you enter a stock with a long-term horizon, but maybe had to exit in 6 months?
Um, okay, and it comes partly with the question you had on the later part, which is your mistakes. So
Sure.
the big one mistake that we can elaborate is our investments into two investments that we made into the housing finance sector, and this was prior to the INFS crisis,
Sure.
right? We didn't get the theme wrong, or neither did we get the cycle wrong. When the financial crisis erupted at that moment, we started realizing fallouts in businesses which we thought we should have actually learned and figured it out a little bit ahead. Unfortunately, financial investing is not something that I had known for in the last 15 years. I mean, that's come to me in the last 5 years where we are learning a lot more about it.
Sure.
But the clear thing that we realized over here is lending is one of the easiest things to do. It's a commoditized business, right?
Sure.
The only thing ultimately which really matters is having a management which has got seriously process-driven systems which can actually originate loans and which can lend it to the best clients, and at the same time have a front-end team which can actually do the collections in the right manner. In a
Absolutely.
commoditized business, another factor which also is very important is you need to have a very low cost structure. This is a simple thing that we wanted to follow. And what we failed is in understanding the management around over here. And we trusted the past track records. Unfortunately, in lending, when you trust past track records and suddenly the managements change, even that culture changes along with them. And in bad market, all of this actually comes upfront. So we didn't see this, and then we realized it, and I think we've become a little wiser than where we were.
Okay. Excellent. Excellent. No, I think, and just to add one point out here, what we're also seeing is that, as you're saying, while lending is a commodity business, and while the front end to disburse the loan is probably the easier part based on due diligence, etc. I think we are seeing a big shift, and more specifically because we track a few fintech companies as well, is everyone is now shifted the problem like, how do I collect my dues, right?
Yeah.
How do I trace a phone, or earlier in the sort of our telecom days where they would send an agent to collect the dues if you've gone on an international trip and have a huge bill. I don't think that's possible. So I think those are the new problems which are definitely.
It's like Warren Buffett gets said once, right? That it's funny that some businesses, some managers actually wake up one morning and say, "Oh, I need to cut cost." Well, that's the part of a commoditized business. You need to be doing that, and you need to be collecting as well. I mean, you can't wake up and suddenly say, "Oh, I need to start collecting now."
Sure. No, but it was a relatively easy game. What a lot of people have captured on, in terms of trying to get things done. And lending money at at those payday loans, 30-day loans, 60-day loans, etc.
Right.
But anyway, I think that's another half an hour of talk with anybody. One of the things that we talk about a lot when we talk to clients is that, especially with boutique investment houses such as yourself, is what we call the skin in the game, right? Would you care to say how much of your wealth is sort of tied into Alder Capital?
So 10% of our assets are in Alder Capital, right?
Okay, so super.
And it's unlike most fund houses, we were not asset managers to start with.
Sure.
So we never appeared on CNBC or never had clients who we were servicing on a mutual fund side that
Right.
distributors that we knew. So the way we wanted to be honest to ourselves was that you put in your own money, you ask your friends and families to put in, and test it out, whether you really can make capital for yourself and others in a sensible manner.
Sure.
Build a framework and a process that works for you. I mean, it's pretty similar to what we used to do as analysts in 15 years, but only through trying to make it more methodical in terms of an investment process. And and then start raising more capital. So the initial capital did come from all of us. And I think in my heydays, I still remember I used to work with INAM. And there was a very interesting thing where the founding promoters actually had told me, saying, you learn a lot more about the stock markets not by sitting around over here and listening to us or meeting your clients and meeting other companies, but you learn more when you take your salary check and you actually invest it into the markets.
Sure.
You'll become a far more better investor then.
Sure.
In fact, we were one of the few fund houses, brokerages, or those good old days, used to have a very active policy of investments. We used to discuss about it on the table, share our thoughts, share our emotions, and that was a very integral part. So I think skin in the game, like you said, is extremely important.
Fair enough. And you also alluded to, look, till you're putting your own money, everything is sort of theoretical in nature and paper returns. And on that, when I started off way back in 2004 as well, I lost 6-7 months of my salary on a leveraged commodity play. And, that has been sort of my biggest lesson till date, right? You mentioned a few mistakes that you made, but would there be something else in your career that you want to talk about, which, you reflect back saying that, look, this was a point which had the greatest learning?
See, everyone should know the limitations, right? And what gives me stability in the markets is not the losses that I have gone through. What gives me stability in the market is the real life learnings that I've had. It's more to do with, I was at a period between, after doing my MBA, coming to Bombay and working with one firm, and I was in a period of 9 months without a job and wanted to get a particular kind of a job, which was a research analyst, right? And I stuck my guns to it because I was getting all sorts of jobs offers, which was to do with relationship manager, because I had done my B schooling in Australia and they really loved my communication skills, at least whatever little bit I have. It was one of the most difficult periods. So what it taught me was how bad can things get, right? And what is it about not having a job, and what is it that what you can lose? When you've seen the worst, and when you look at the markets and you have a bad day or a bad year or something like that, you say that, there's nothing wrong in this. So long as you've been doing the right things, you've been focusing, you have been true to your own cause, it comes back to the same point, right? Sure. So it's more about real life than about stock markets that has taught me more.
Okay, fair enough. And on the topic of doing right things, if you could also elaborate on one of the opportunities that you probably saw in the market, which was quite obvious to you, but the majority of the market maybe missed it.
So one investment that we made way back in 2017, right, was in the healthcare space. And in particular, one that we did was Dr. Lal Path Labs. And it's actually one of the largest holdings that we have today. It is the largest holding we have today because it's done so well for us. But the point is that at a particular moment when we were looking at the stock, the two things which were reverberating at least from all the analysts, were unusual amount of pricing pressure, and B2C business like Thyrocare was killing it. And very soon the margins will get destroyed and things will go out of hand, and the price is just really obscene. And the other thing which was more of a short-term pressure was the private equity fund, who was an investor in it, constantly was selling right through from the IPO in 2015. So the stock found a new low in late 2017. But what everyone kept missing out is that in an underpenetrated market, right, where you have a B2B competitor who is trying to bring down prices, and you have another large player like Dr. Lal, which is extremely strong as a B2C company, and not understanding what consumers really want, because the consumer wants trust, right, and convenience more than just price. People keep putting price ahead of these two factors, and we keep wondering, what are you really talking about? But that was a simple thing. There were a lot of research which was put out by surveys, which actually said in micro markets that, what consumers really want. Price is one thing that people really want, but at the end of the day, if you go to your cardiologist and say that, this is the test I had, and it was a live incident I had in Bombay where he said that, no, this will not work. You get me from this particular place because I don't trust these guys' report. So that's what got us thinking a lot more, and we took a sizable position. So Yeah, simple things actually.
Okay, fair enough. One of the questions also is, and there's been a very, and I have to say, there's been a very varied answer for this question. But I come from a long short trading background. And I've always felt that giving the option to a fund manager to sort of be able to use different tools, maybe to hedge, maybe to take an option position, maybe also to cash manage, or reduce cash significantly, or go to zero, or 100% cash, or 80% cash, is something that is useful at different points in time. You being obviously a long only PMS fund manager, would you want to have that optionality going forward in terms of levering and multiple other tools to improve your risk return profile?
So there are two things over here. One, we never hedge, and we don't take an opposite position, which is a short.
Okay.
But what we do is we essentially move to cash.
Excellent.
And the moment we move to a huge amount of cash, it becomes a natural hedge for us. We have gone to the extent of having even 60% as cash position in our portfolios.
Okay.
Right? I don't see any fund manager probably going to that extent.
And
but
when was that? During what period?
So this was at the time of when the demon was announced.
Okay.
Right? And we felt like there's a lot of things that are going to go wrong out here because we couldn't understand how consumption will continue at that particular moment of time.
Right.
But we were quick to actually deploy it also when things were actually not so bad, and we realized the mistake which we and others are making in the market. But at the beginning of this crisis, more like in Jan and in Feb, when we started seeing what's happening, we've slowly built a position of cash to a peak of around 55%, right? And only deploying it where we thought it was making sense to us. So it becomes a natural hedge. And the other thing that we don't like to do when we are trying a long and short is that when we start taking short positions, it sucks in a lot more time. Yeah, it makes us focus on a daily basis.
Sure.
What's really happening in the markets. We frankly are not those kind of guys. We don't have an active trading monitor in our office. We don't have the television switched on. We don't like to see TV, basically. In fact, if somebody comes in the evening and calls you up and saying, Hemant, did you watch that? I said, watch what? And then I will probably go on to CNBC or somewhere else on the web and pull out that link and try to see what it was.
Right.
But quite honestly, we don't want our time to be wasted on trying to figure that out. We try to do is to make sure that you try making less mistakes, so that you don't have to think about the compounded returns that you will get. The more less mistakes you do, the better returns you will have over a longer period of time. It's as simple as that. So if you can try to figure out what mistake are we making in the current holding or what we want to buy into, I think we have done our work. It always comes back with the thought process that we knew this is going to happen, but I think we try to have a lot of restraint in doing any of those things.
Sure. No, fair enough. As I said, it's a very varied, talked about topic. And it's actually what separates a good number of philosophies in terms of you're trying to do everything together. You should be bucketed into maybe a long short fund, as against trying to do and pick the right stock for a longer period of time.
Agree. Yeah.
So we are almost at the end of this conversation, Hemant. But one of the things that has come up recently is, what would you say to fund managers who've just started their journey, investors, or sort of people who've taken external money from friends, family, a few sort of investors, etc., maybe in the last 2 quarters, and are seeing a good amount of pain. What would you suggest to them?
So the one simple advice that young managers would have who probably are have investment experience for the last 5 years, haven't seen multiple bear markets like I have at least seen twice in my career, is you have to be honest, right? Honest, not I'm talking about with the investors, but to yourself. If you're not honest about what your limitations are, right, it's a mistake. If you're not honest about the amount of effort that needs to go into understanding an investment idea, it's a big mistake, right? You got to be honest about asking all the difficult questions, right? And it might be difficult, so that's why it is a difficult. It's a science and an art. So if you're not going to be honest about doing all of this and the basic hygiene factors, it's going to be far more difficult than what you see. And the moment you've done your homework, and this is what we keep telling ourselves as a team, I mean, irrespective of where the markets are, just keep doing what you're supposed to do, right?
Sure.
Pick a company, drill down for 3 weeks, you'll come back and you'll feel so elated about it. You'll be so happy that you learned something new. And that's what drives us, actually. So that's the most important thing. And apart from that, any fund manager who starts off in this business has definitely got an investment process and a framework.
Sure.
When you decide that something is your investment process and something is your framework, do not break it, right? The moment you start breaking those just because of your peer pressure, that some other fund manager is doing better than you are, your client is calling you up because you're losing money, those are things that you got to put it on the side, right? Because if you are going to be in the game of investing, just like in cricket, right, you're not there for just knockout on a one single day, right? You want to be a Rahul Dravid who keeps playing and becomes the wall.
Sure.
So I'm in the game for being a Rahul Dravid. So now if you want to be someone like him, you really have to actually stick to the process and the framework. The moment you start breaking it, I mean, God help us all.
Okay, fair enough. I think that those are golden words to definitely take back home. But thank you so much for your time, Hemant. I think it was a very interesting conversation from our side. Hopefully, you had fun, and this is something different that you experienced as well. Is there anything that you would like to add from your side?
No, I think a few years back, if you'd asked me that this is something that we will be doing across on an iPad and a computer and putting this up for people to see, I would have said, no, that's really weird.
Sure.
But yeah, this seems like a very interesting thing. I mean, I would love to actually engage a little bit more with other fund managers as well. I mean, that's something that maybe you can put up as a roundtable next time around.
Absolutely. I think this is, this gives us an opportunity, one, to talk to people such as yours, which might, generally, makes it a bit more difficult in the physical world, in setting up, in, getting time, etc. per se. But yeah, definitely we have 3-4 other things lined up, and let's see where this goes.
Fantastic, Jay. It was a pleasure speaking to you today.
Thank you so much.
Forward to having more conversations like these.
Absolutely. And, here's wishing you a wonderful 2020 from an investing point of view and otherwise.
Thanks a lot. Take care and stay healthy.
Okay.